It's Friday, May 29th. I'm Brian Walsh, and welcome to This Week in Impact, where I talk with ImpactAlpha journalists and editors about some of the most interesting impact investing stories we've been covering. This week, I'm joined by editor Amy Cortese. We'll discuss two approaches impact investors are taking to address big tech's massive AI data center buildout, plus PE and 401ks. In the name of democratization, private equity firms eye U.S. retirement savings. And finally, how 2X Global is spurring a global race to the top for investing with the gender lens. That's all coming up on This Week in Impact. Hi, Amy, and welcome back to the podcast.
Hi, Brian. Great to be here again.
All right, first up this week, the AI data center build-out by big tech firms known as hyperscalers is enormous, fast-moving, and creating real environmental costs. This week, we had two items that dealt with the two ways impact investors are working to engage hyperscalers on minimizing the environmental downsides of this boom. Shareholder pressure for more disclosures and investing alongside hyperscalers to encourage clean tech deployment. Amy, let's talk about shareholder engagement first. Kirsten James of the nonprofit advocacy organization Ceres had a guest post arguing that shareholders should engage public companies on AI's downside risks. So what's the case she's making?
Yeah, Brian, Kirsten wrote specifically about water risk. And as we know, data centers gobble up huge amounts of water, and they're being built in places like the southwest of the United States, where these areas are already drought prone. So water is a big issue, as is energy use and rising emissions of data centers. So Kirsten was basically arguing that these data center operators need to do a better job of disclosing their water usage, and not in aggregate, but down to the facility level, what they're taking in, how they're recycling it, like what they're putting out and where. And then for investors, she argues that they should continue filing and voting on some of these shareholder resolutions that are trying to hold data center companies and big tech firms accountable for their energy and water use.
So, Amy, what does greater disclosure of the water risks by these AI build-out companies actually accomplish?
Well, from an investor standpoint, Brian, there's been a lot of community pushback on these data centers, right, for these issues like water usage, energy usage, pollution. And so a lot of these data center projects are getting canceled in light of the community pushback. So if you're an investor in one of these companies, right, you want to make sure that they're working with communities in a way that is beneficial to both, and that their data centers go forward. Otherwise, it's a lot of wasted time and energy. And by the way, communities deserve to know what the water usage is or the energy usage is, what the plan is around that. So it's just transparency, which smooths the way for the data centers and benefits communities and investors.
Right. So from an investor perspective, they want the disclosures because they want these data centers to be built. And without the disclosures, the local community pushback would be even more extreme and would hamper that growth in the data centers. In addition to the water usage issue of these data centers, there are other issues related to the data center build out that we wrote about this week.
Yes, Brian, we did a little bit of an update on the proxy season because some of the big annual general meetings for some of the tech companies are this week and next week and in the coming weeks, so a little later in the season. And a big focus this year for investors has been AI and the data center build out. So there are a lot of shareholder proposals in addition to water usage, but on how some of these big tech firms are squaring their rising emissions, right, from all of the energy use, often fossil fuel powered, with their climate goals that they've made in the past.
Yeah, so can you walk us through a few specifics about how shareholders are voting?
Yeah, well, first of all, some of the main movers behind these proposals have been companies like Trillium Asset Management, As You Sow, and the Presbyterian Church, and also Mercy Investments. So they have fielded proposals at Amazon, Alphabet, and Meta. Meta's happened this week. And we don't know in all cases yet what the voting outcome has been. Amazon shareholders, I think, gave less than 20% support on this particular issue. Now, some of that is due to the dual class shares where insiders have more voting control at some of these big tech companies. But, I think even if it's 20% or so that ends up voting, I think the shareholders feel like this is their way of putting companies on notice and letting them know that they will continue to try and keep them accountable.
All right, now shifting gears from shareholder engagement, there are other impact investors that are working alongside the hyperscalers to help them invest in deploying clean tech solutions. Now, you wrote about that for us this week, Amy. Tell us about what you found with Elemental Impact.
Yeah, so Elemental Impact is a nonprofit investor that invests in climate, and they're working with a lot of portfolio companies that are, trying to get through that tricky commercialization stage, which is very hard. You're either building your first plan or you're trying to get your customer traction and your deployments that can be, broadly adopted by other companies. Elemental launched what it calls the Data Center Innovation Initiative. So they're working with Microsoft, Google, Meta, and Amazon to pilot a range of clean tech solutions that could be low carbon cement or eco-friendly industrial cooling or, certain high efficiency electrical systems to help startups test their products in these real world data center environments. And then the tech companies are going to share the results of that so that it's easier for their peers and for other companies, whether that's, manufacturers or hospitals or schools, to also pick up and adopt those same solutions.
So Elemental's investment here is really catalytic because they're trying to share what's working and what's successful at bringing clean tech to the data center build out more widely across the ecosystem.
That's exactly it, Brian. Elemental will invest between 500,000 to 5 million per project for up to about 10 technology startups over the next 2 years to help them do this deployment. And they do see it as very catalytic, just like their work with first of a kind, funding first of a kind factories, which they've been working on for several years.
So who are some of the backers of this Elemental Fund?
Yeah, it's philanthropically funded. So Breakthrough Energy Discovery, Builders Vision Philanthropy, Salesforce, and the Stolt Family Foundation are putting up the initial capital. I think that could potentially grow. And then there's another piece of it, which is that the technology partners, Microsoft, Google, et cetera, also pay some sort of annual dues to help, cover the costs of running the program.
All right, so Elemental's impact thesis here is if they can provide this catalytic capital to de-risk these pilot projects that commercial capital won't touch, that they will end up helping to bring clean tech throughout the data center ecosystem.
Brian, yes, very well said. It's actually all about scaling some of these technologies, and you might as well take advantage of this massive industrial build out that is happening with data centers and help make them more sustainable.
I mean, they're called hyperscalers for a reason. So if we can embed sustainability into how they scale, then that'll be good for everybody.
Absolutely.
All right. Well, you can read two approaches to how impact investors are engaging in the AI build out. Amy's article on Elemental Impact and Kirsten James's of series guest post on shareholder advocacy on impactalpha.com. There's also a link in our show notes. Later in the show, we'll discuss 2X Global and the effort to encourage more gender lens investing with integrity. But for now, we'll take a quick break. When we come back, how private equity, including impact funds, are coming for Americans' retirement accounts.
Hi there, Agent of Impact. This is Dennis Price, CEO of ImpactAlpha. For more than a decade, ImpactAlpha has been helping you find the alpha in impact. We've now built ImpactAlpha Edge to bring you structured data and market intelligence to help you move faster, invest smarter, and multiply your impact. ImpactAlpha Edge is designed to help GPs and fund managers raise capital more effectively, LPs and allocators find each other, and discover overlooked opportunities. Think of it as a purpose-built pitch book for impact, with the editorial judgment and network trust that no algorithm can replicate. Come check it out. Book a demo today. Learn more about ImpactAlpha Edge in our show notes.
Next up, there's been an ongoing debate about what type of investments should be available for the retirement accounts for everyday Americans. On the one hand, there's a case for democratizing access to the potential wealth-generating capabilities of private equity and other private investment vehicles, including impact-themed funds. These funds are generally only available to institutional and accredited investors so far. On the other hand, there's a case for protecting retirement accounts from the risky bets, high fees, and illiquid private assets. Amy, you and our podcast producer extraordinaire, Isaac Silk, wrote about this debate, which was featured on the first episode of the third season of the Impacted podcast, which is part of the ImpactAlpha podcast network. So tell us what's at stake here, Amy.
So the premise here is that companies have been waiting longer to go public, if they go public at all. So there's a lot of wealth being created in the private markets that, as you mentioned, retail investors and retirement investors generally do not have access to. So there is merit in this idea of democratizing financial markets. The problem is, as we know, these private equity investments, private credit, crypto is part of this rule change. They can be incredibly complex. They can be costly, like the fees for a private equity fund are, very expensive compared to like your average index fund in the private markets, your average ETF index fund. And there are longer lockup times. So the devil is really in the details here. And I think the general feeling is that we don't yet have the guardrails or the policy framework that is necessary to protect investors from some of these risky alternatives.
Now, Amy, you just mentioned a rule change, and in the US, the federal agency that actually oversees retirement accounts and regulates them is the Department of Labor. And Ben Schifrin of Better Markets did a good job of laying that out on the Impacted podcast. So let's play a clip of that right now.
I think the biggest change is the Department of Labor's proposed rule or guidance to fiduciaries that's intended to provide them with a so-called safe harbor for investing 401k plan assets in the private markets. Private markets are notoriously more risky than public markets because they don't have the same disclosure requirements that public market assets do. They don't have the same liquidity that public market assets do, and they have higher fees than public market assets do. This has made the managers of 401k plans wary of investing in the private markets. There's a push from the administration to open up these private markets to 401k plans. We're seeing that at both the Department of Labor and the SEC. And recently, the Department of Labor just came out with a proposed rule to kind of put its thumb on the scale of private market investments and say to fiduciaries, hey, if you follow this process, we're going to give you a safe harbor so you can't be sued, which is what fiduciaries are fearful of. They're fearful of putting their participants in these riskier assets and then getting sued if something goes wrong. And so that's the biggest change. There are other changes at the SEC that we can talk about, but that's the one that's getting the most attention right now.
So, Amy, in any market, you have supply and demand, and it's not clear whether the supply here is access to these funds or the supply here is access to the retirement savings account. So who's actually clamoring or pushing to make these assets available for retirement accounts?
Yeah, we've been writing quite a bit about this over the past several months, and it was a vibrant discussion also on the Impacted episode. But some of the biggest proponents of these rule changes that would allow alternatives into retirement accounts are big PE firms like Apollo Global that have mostly to date played in the private markets. And they're eyeing this, like, whatever it is, $14 trillion retirement market. And then you have big asset managers like BlackRock, which has been mostly in the public market, and they too are, talking up the merging of public and private markets. So these firms and many others, I don't mean to just pick on those two, but they're rolling out these what they call semi-liquid funds to appeal to retirement investors and retail investors. However, emphasis on the semi, right? Because we've seen, especially in the private credit market, some of the first retail investors in, and they tend to be high net worth individual investors that have been in some of these funds, have been trying to get their money back, and they're finding that the redemptions are actually very limited. So, cautionary tale. But Ben actually put it very well when he said it's not retail investors that are clamoring for access to these illiquid, opaque, risky private market assets. It's actually the private funds that are, pushing to get access to retail investors.
Right. So one framing is it's democratizing access to these wealth building opportunities, and the other is opening up the door to predatory, high risk, high fees to kind of take advantage of those everyday retirees.
Yes, and to be clear, there are people in the impact space who think this is a good idea. And, when you think about it, most of the high impact funds are private impact funds. So if we want to spread impact investing and open up access to that, it could happen through, changes like this. And not to say either that all of the, private equity funds are necessarily bad either. It's just we have to be very careful because they can be very risky, and it's often just a mismatch between what retail investors, their level of sophistication and, the product that we're offering to them.
Yes, a buyer beware.
Yes.
All right. Well, you can read Amy and Isaac's write-up on the private equity and 401ks on ImpactAlpha.com. There's also a link in the show notes. We also have a link in the show notes to the Impacted podcast episode on this topic. Be sure to subscribe to their feed so you never miss an upcoming episode of their third season. For now, we're going to take one more quick break. When we come back, 2X Global and the efforts to encourage more gender lens investing. Finally this week, gender lens investing has a credibility problem. Not because the performance case is weak, but because anyone can slap the label on a pitch deck. This week, Impact Alpha's David Bank was in Lima, Peru at the Gender Lens Investing, or GLI Forum LATAM, where 2X Global's Jessica Espinoza talked about how a third-party certification is changing that and creating a genuine race to the top among fund managers who want the designation. Amy, to start us off, tell us more about who 2X Global is.
Yeah, Brian. So 2X Global is a nonprofit that has come up with criteria to help sort of cut through some of that pinkwashing that you're talking about. So they're focused on gender lens investing, which I think most of our listeners know, but is about inclusion, but also about getting to that financial outperformance of funds that are run by or investing in women. So female investors are 2 to 3 times more likely to invest in other women as founders or entrepreneurs.
Yeah, and because of that outperformance, the gender lens investing market is really growing. I was really interested to read in David's piece about this $34 billion has now been directed towards gender lens investments by 2X Global's 150 plus members, up from original $30 billion back in 2018. So it definitely is a growing market. And so I could see now the need for this kind of certification. So walk us through the certification that 2X Global is doing.
Yeah, they launched it about 2 years ago. And so it's this certification process to, kind of get to who's doing rigorous gender lens investing and who's not. So there's 3 designations, which are good, advanced, and best in class. And they're covering things like share of women ownership and leadership, and who you're investing in, what's in your portfolio. Are you investing in women-led companies, or, companies that have products and services that are benefiting women and girls? So it's a whole bunch of stuff like that.
And is this certification just for fund managers?
No, actually, it's broader. So companies that might be a portfolio company can also certify, I believe.
So Amy, how are funds using this designation?
Well, a lot of funds see it as a differentiator, right? You want to stand out in front of investors and limited partners. And for LPs that care about this, getting a 2X certification is actually a big differentiator and helps you stand out. In fact, at the Glee conference, Jessica told David about a big Asian private equity fund that really wanted to be best in class, and they didn't quite make the grade. So they came back a year later and they had revamped their whole profit structure to share more of the fund's carried interest with their female partners. And they got their best in class. So, I think people do see it as the high bar. And if you achieve that, you do stand out.
All right, very interesting. Now, you can read David's piece on 2X Global and their new certification system for gender lens funds and companies on ImpactAlpha.com. There's also a link in the show notes. But that's going to do it for this episode of This Week in Impact. Thank you so much for joining me today, Amy.
Thank you, Brian. Always a pleasure.
And thank you all for listening. This Week in Impact is a production of Impact Alpha and part of the Impact Alpha podcast network. Smart conversations by and for impact investing professionals. For exclusive stories and insights about the world of impact investing and sustainable finance, join thousands of other agents of impact by subscribing. Just go to impactalpha.com/subscribe for full access. Thanks, as always, to our producer extraordinaire, Isaac Silk. For Amy Cortese, I'm Brian Walsh, Managing Director of the impact advisory firm Human Nature. We'll see you next week for more impact.